Happy New Year and Merry Christmas. This is our first podcast, and it's been like what, almost 3 weeks now, off for the holidays. It's good to be back. Honestly, not too much happened until just the last week and a bit, so it wasn't too bad over the holidays. But some few things that happened recently. Obviously, we got the Venezuela situation. Going to talk about that a little bit, how that affects crude oil. Crude oil is up since that happened. So I did see quite a few posts saying like this is going to actually bring inflation down, but I don't really think that's going to be the case. So that's one thing that we'll talk about today. And then tomorrow we've got unemployment numbers coming out, and we also have the tariff decision in courts. Is that going to get shut down? Are they going to say that the tariff taxes are going to need to be repaid? Is that what's going to happen? We don't really know. So we'll talk about that a little bit as well. Why don't we actually start with that? So in terms of the tariffs getting canceled in the courts tomorrow, Polymarket's got that at what, like 70%, over 70%. So it does seem like that is being priced into the market more or less, that it's going to happen. Obviously, it's just Polymarket and Kalshi, so take that with a grain of salt. But I feel like that's not going to be that big of a shock to the market. I think a big shock to the market would be if these tariff revenues need to be refunded. What are your thoughts on that? What do you think's going to happen?
So I think that the big argument here is two stages. Number one, does Trump have the authority to enact these tariffs, right? Because that's where the Supreme Court is at the moment. Not so much does he have the authority to enact these tariffs, but how is he enacting these tariffs, right? And tomorrow, while it's probably going to be a preview, and I assume there would be more kidding with the more not kidding negotiating with this topic, but I would assume that you'll get more clarity tomorrow in the direction of where the Supreme Court's thinking, right, and what they're thinking. And I'm pretty sure like the way the administration has lined this up comes down to the fact that they believe that if they do lose the Supreme Court ruling, or they get signs of them losing the ruling, they can always enact tariffs in different ways. And they've been very clear and public about that. And what that really means is, while there may be a 70% chance that Trump loses the Supreme Court ruling, or at least is expected to lose, if need be, there is probably a low net probability that tariffs are going away. In the essence, where they can simply, the administration being they, can simply just reroute tariff implementations through other rules and exemptions, and essentially put up a tariff wall that can't be taken down as swiftly as just the Supreme Court saying no. And I think that that's really what matters here, not so much tomorrow's ruling. I think the idea of tariffs being here are to stay at the moment, and the only question is are the tariffs enacted under the exemption, or the rule which would be found invalid by the Supreme Court? Do those collect tariffs have to be paid back? That is probably the big confusing factor here, where the idea of tariffs continuing is more certain. I'd like to imagine, I think is the case.
Yeah, I mean, knowing Trump, like he's not gonna just give up if they do rule against it. He already said he's got backups on backups,
Right,
so
right.
they're gonna make it happen no matter what. And I think that's probably why the market is shrugging it off. Like there isn't really, like it's not selling off into this or anything like that. So yeah, I don't think it's going to be that big of a deal, just because he's gonna figure out a way, and I think the market knows that.
Yeah, I think early on there was more confusion on like how quickly these would be ruled down, and if the rulings were more definitive, in the sense like these tariffs that have been put in place do they get shot down in entirety rather than, just taken down to be put up in some other manner? And I think that's really what we're going to see tomorrow. And on top of that, on a regular macro note, we do have NFP tomorrow. So tomorrow's going to be a bit of an eventful day in the markets.
Yeah, absolutely. And we've actually so we got the jobless claims numbers today, and we have ADP as well. So like those are actually all looking fairly good. We did have a bit of kind of like a labor market slowdown during this risk off period over the last few months. Just looking at ADP, which was one of the few data points that we were able to see. But it seems like we've recovered from whatever that was. It was some sort of slight slowdown in the market that seems like we're now coming out of it. So I'm curious to see
Yeah.
what the jobs numbers are going to say tomorrow, if that's going to um, be in line with what ADP was showing as well.
I mean, obviously we have some disconnections between the initial numbers, the revised values, where they get revised to, and what the last values look like revised. So there's a lot of things that can move the market. If tomorrow's number's okay, but there's a major negative revision for the prior month, right? Like um, things start to get kind of wonky, right? Because we were looking at having basically 64,000 payrolls added in November. And if that gets revised down significantly, but tomorrow's number is okay, then obviously the market's going to get spooked. I do have to say that over the last couple of weeks, or last, let's say, 6 to 8 weeks, the fall off in jobless claims, and if you look at continued claims, them as well, just basically stalling out, for the better term. I think it's noteworthy. I think that it doesn't mean the unemployment rate's it can't tick up. It doesn't mean that NFP can't be weak, but I think some of the slowdown we've been seeing in the economy, which initially started as a risk-off shock, turned into a slowdown. I think there's some arguments to be made that things are improving, but you got to be a little bit careful at the same time. Whereas, we're in a macro environment that goes beyond just just organic macro headlines like NFP, CPI, PCE, the typical, right? Main three every month, and then obviously jobless claims every week. Those can move the market. ISM, these types of organic macro headlines, and then you can have these inorganic macro headlines where things are enacted, like tariffs overnight, invasions, these things that are very inorganic in the sense of stability. And that's, I think, where the risk is at the moment. Given what we're seeing again with claims and initial and continued claims, I don't think that the NFP print tomorrow is going to really spook the market unless there's some ridiculous revisions or a gigantic miss. I do think that at this point, labor had the opportunity to decay significantly, and it didn't. Right? Like, continuing claims couldn't rip, initial claims couldn't rip, and I think that these were things that we would see on the up and up, well ahead of the NFP numbers and the unemployment rate, in a truly deteriorating and weakening labor market that is problematic for the economy.
Yeah. Yeah, like I don't think we are out of the weeds just yet, but conditions are definitely better than when we initially went risk off. And even just throughout that whole risk off period where there was kind of just deteriorating data hitting the market. So I'm pretty hopeful. I think this first quarter, maybe the first two quarters, I could see the market doing pretty well coming out of this choppy period that we've had over the last 2.5 months. That kind of just gave equities kind of just some breathing room, because equities really were running away from reality. And so this chop over the last couple of months really just gives it some breathing room. And now I hope we could head higher for at least the next two quarters. That would be nice.
Yeah, and I mean, I think the thing that we have to look towards is the dynamics that are going on with tariff impacts of flows in terms of exports, imports, and how that's bleeding into GDP estimates and whatnot. Like we saw a huge GDP now number today, made headlines all over the internet, obviously because it's a five handle on real GDP as per Atlanta Fed, which um, it's a bit noisy, especially early on. It becomes more accurate over time, but it's obviously a welcome sign. How real is that 5% print going to be? We'll see. And are we looking at bottom or top? Like, is it just top line growth, or is it really flowing down to bottom line as well? And a good view of that is this will update soon for the 5%. But what we need to see here is the real final sales of domestic purchasers, and this is basically the consumption in the economy, right? This goes beyond just imports, exports. It's measuring the underlying consumption and call it real demand. If this is also up and not down, it's a very good sign. And the importance of this is very simple. So on a long enough time scale, if you look at what happens, you don't get recessions without the blue line being negative. So if the orange line is real GDP, if it's misstated to the downside or misstated to the upside, however it may be, as long as the blue line is not negative and not really falling, the economy is okay. And I think that where we are right now, you're seeing major increases in productivity. And these are things that I think the market likes, obviously for many reasons. But if productivity is increasing without a substantial contraction in job contributions, like significant, where they're in per se negative in a recession, right? Because they'll go negative in a recession and productivity will be positive. And people will say, oh, productivity is only positive because everyone's forced to work more because there are like jobs are in the toilet. Everyone wants to keep their job. Productivity goes up. Everything gets the fat gets trimmed. Everything becomes leaner. But in an environment like this where the job market's still growing and we have this outsized productivity, I think this kind of goes back to our general AI theme from 6 to 8 months ago.
Yeah, absolutely. Where the risk though is that productivity is not as stable as a consistent job growth economy. So when does that productivity stop making up for the lack of job growth? That's really the question. And I don't really know how to figure that out. I mean, obviously, like we just have our system. That's what we're going to rely on. But I don't know what kind of data points to look at that might be telling us ahead of time, okay, productivity is actually starting to slow down and the labor market is still not picking up. That's where I think we're going to start running into some issues.
Well, yeah. So like if you think about it like this, the labor market is bound by one thing, and that's the employers, right? So the employers are the controller of the labor market and ex-government, right? So if the employers are the controller of labor, right? The employers have to have a reason to hire, B, a reason to fire, or C, a reason to optimize. And if the employers can figure that they can optimize the workforce without massively restructuring it, they're going to try that first, because if they can optimize every employee and increase the unit output per employee with higher productivity, essentially in some industries, having more people increases the economic output. And if you optimize said people, you can further increase the output. You don't necessarily need to fire them. And this is where, like, I think we are, at least, where AI isn't necessarily at a point where you're replacing jobs, but you're heavily optimizing roles where maybe you don't need as many new roles, maybe leading to a lower hire rate, but the roles that you do have are stable and can be optimized, leading to also a low hire and a low fire rate, because you don't necessarily need to get rid of people, but you don't really need new people either, because you're optimizing your existing workforce. And I think that's probably what's been a driver around a lot of this, which people have been having a hard time measuring, and that's the intricacy of artificial intelligence within the labor force, because it's very so much from sector to sector. How much, some sectors are just more prone for AI uptake than other sectors, and then within those sectors that are prone for AI uptake, there are a bunch of different factors of how fast each company is able to uptake AI. Like, some companies are more cutting edge, some are not, and this creates this whole bifurcated effect where it's not so easy just to say, okay, AI optimizes, everything's optimized, where, some things are still done very, very old school. Some companies are disrupting these spaces, and then you have a bunch of disruptors that are not all moving at the same speed. And at that reason, they have different factors of productivity, right? And I think that you blend all this together, you have the economy. That's what the economy is. And what we're seeing here is obviously a couple of things. Labor force isn't getting decimated. It's slow. It's hard, it's tough, but it's not getting decimated. You're not seeing a major acceleration in work hours, so it's not necessarily the work hours are drastically increasing, but the output is. So that's what this chart's really measuring you, the composition. You're really just seeing huge composition emerge from productivity. And it's very noticeable over the last 10 or so years. You can see here that productivity has been very, very stable ever since LLMs became a mainstream thing in late 2022. And it just goes to show that there's some sort of AI effect here that I know a lot of people want to either definitively say AI is or is not, but I think in general, AI is having a positive effect on productivity. And the only problem is it comes down to, if those productivity enhancements do slip, that's where the risk is in the economy in terms of growth going forward. And a simple way to think of this is, think of this like in a simple sense of customer support, right? If LLMs are good enough to replace customer support, and they do, massive improvements, massive scale, massive productivity enhancements across labor forces, right? Great. But if the LLMs are not advancing at a exponential rate and they become even linear to flat, what ends up happening is the further advancements become limited. So yes, you've optimized your customer support with the chatbot, but have you really taken that technology into the company further to further optimize output? And LLMs are not AGI, obviously, so there's limitations to their implementation in some of these companies. And I think that while broad and great, we have to acknowledge that, look, there will be companies that hit scaling limits with AI, at least in the current form, unless something drastically innovates in the short term. And it could be one of many things. Number one, it could be the model constraints. Number two, it could be cost, or it could be even access in terms of having enough, if it's compute or whatever these larger companies are trying to achieve with supplied power. So I think that we're at a point here where productivity contributions will continue to dominate up until, I'd argue, the theme in AI shifts, or in terms of output, right? If that shifts, if output capabilities of AI shift or degrade, I wouldn't be surprised if productivity contributions slow down. And a good way to think about this is just say like this, right? So zoom out and really look at this and say, productivity growth has been strong, but are we going into this exponential phase where productivity is going to dominate everything, into the sense where you don't need jobs for output at all? And I think that to make that point with where tech is today is a bit hard. And you can just see that while growth is expected to be strong, shutdowns and import flows and whatnot, I do think that if you are seeing a major ramp in productivity, I'm talking, extreme exponential, out in terms of model outputs and value, the market would at least be going more linear in fashion, higher, to say the least, right? Like the NASDAQ going sideways for 3 months like this, when it almost feels like the market has kind of figured out that, like, you look at Nvidia, right? Like, Nvidia's still holding bullish trend, good sign. It's not a bad looking chart if it can hold trend. And these are not reasons to necessarily be bearish on the market either, or the environment. These are things that you should be thinking about as precautions or warning signs, right? Like, what we'd like to see is, if AI is going to continue developing and the uptake is really going to be exponential in perpetuity here, these companies that are leading should continue to lead. And obviously bubbles can rotate, right? In terms from hardware, software to, if it's memory, whatever it may be, outside of compute. I think that you need to have a stable base here where the leaders are going to continue to lead. Because if you look at it like this, right, Google should continue to do well in an environment like this. If AI models are ever so advancing, Google should continue to do well, because if that's going to be the power that is powering the contributions to if that's what's powering the productivity contributions to the economy, well, then as the economy scales and those productivity enhancements ramp, these suppliers should continue to do well. So it's a side by side lock and play type of thing. Whereas if these companies are not doing well and they're really getting smacked up, well, you can argue that a couple of things are happening. Either the business cycle is slowing and it doesn't really matter what AI does, which is a hard argument to make, or the level of enhancements that these companies are releasing and incorporating into their current tool sets are not enough to drive volumes consistently higher. And I think that's what we're really in the midst of, which is what makes reading the economy so hard at the moment, right? We just had a shutdown, we just had a bunch of tariff scares in the last 3 to 6 months. Last weekend, we just captured a foreign leader, right? So like, things are hectic in terms of the inorganic macro news cycle, like we were speaking about earlier. But in terms of what really matters, it's going to be growth, and what's driving growth, I think, has been productivity contribution. So anything that's going to continue to drive productivity contribution should lead. If not, in our belief, it's been AI. And you have to be very quick to question if AI is going to continue. And the way that I would do that is I would say, NVIDIA, these companies need to hold. They need to hold their trends. They need to base. They need to go higher. I mean, you have companies like AMD that they've stopped going up quite a while ago. I mean, if you just look at SMH, right? SMH is up quite a bit, but the main leaders in the space, obviously this is due to internal rotation, but the main leaders in the space have been slowing. So this is a good sign, but we'd want to see the main leaders pick up and come back into the race. I think that would really quell some concerns here and really give more conviction to maybe other individuals who aren't too sure if the macro cycle is rolling over, which I think, to be honest with you, that was the scare the last 3 months, but it's coming to an end.
Yeah. Yeah, it's interesting point you make about how it's mostly all about productivity. Like it's almost like we're entering a bad news is good news kind of environment, as long as it doesn't affect AI productivity.
Well, the thing about AI productivity, like I said, a good example is, think about it like this. Imagine you have a factory, and your factory takes orders online with a chatbot, and then you have the actual factory you're producing things. If you optimize the intake chatbot, right, via AI using a chatbot to intake orders, you can maximize workforce in the warehouse. But can you take an LLM? Can you take Anthropic and can you put it into a robot and have it start doing things in the warehouse? And this is actually a good question, a good dilemma, because there are robotic divisions and robotic enhancements, like Figure AI is working on this. There's a lot of companies, Apptronic, they're trying to solve that problem of the warehouse and the home use, but we're not there yet. We don't have we don't have the scale. I know Boston Robotics came up with something last week or in the last week about this as well, trying to really build an all-around robot. And I think that there's this bridge that everyone has illusion has crossed, in the sense that AI has changed the world. But AI has changed the face of the world, but not the internals, at least not yet. You don't have enough robotic enhancements inside to where, car plants are just entirely robotic for the most part, right? And this is where I think the economy may actually hit some issues in the long term of AI absorption, where you have these things in America like unions that we have the ability to automate ports, for example, but not every port is automated because of the unions. And I think that that's actually the unions in our economy are more of a risk to AI than anything else. And it's the risk of slower adoption, or call it fragmented adoption, the semi AI adoption, where you can't adopt it the whole way because you need to have a physical person working, so you can only do certain things. And I think that in a true exponential free market environment, AI, by definition, if if the exponential curve for enhancement is true, should absorb all industries, right? In terms of anything from robots making cars, from the raw material to finished product without human involvement, because again, it's it's schematically laid out. There's not much variation. It's a car's a car. You produce from A to Z and you have a car. A robot can do this, at least a very advanced one should be able to do this. Now comes the factor of, are you going to displace the entire factory workforce in America? And this is where, like, I think politics play a role. And I think that these two arguments are taken at the same time on the internet, but they're very different, right? Because you dethroning tech support or chat, or call it telephone support or tech support on the phone with a chatbot, is very different than you dethroning the entire manufacturing base of the country, right? Because that there's still accountants, there's still other things that you can do instead of being a tech support representative. And what I mean by that is there's other roles, face-to-face roles you can have, and accounts a bit of an obscurity, but you don't necessarily need to be on the telephone walking people through how to use their account. Chatbot can do that easy. And I think that a lot of people are taking the argument that, look, we're automating all these front-facing things and it flows all the way through the economy instantly, and it doesn't. It just doesn't. And I think that that is probably where productivity contributions will hit a limit. It's going to be political. It's going to be capped due to whatever it may be. Too many people are not getting jobs. Too many people are losing jobs. I mean, just look at it like this. All of a sudden, mortgage rates have become a problem in the government, right? The government's concerned about mortgages, and this has been, Biden's concerned about rates. Trump obviously concerned about mortgage rates. Everyone wants the cost to afford a home to go lower, but the way that you solve this is you have to let prices fall. And if you don't want prices to fall because too many people own houses, you don't want the people that own houses to get hurt. You have to politically intervene and construct something so new people can buy homes, but the people that already have homes don't get hurt in the process. And that would be through artificially lowering rates. And you're seeing that trying to be done today with Trump's initiative to spend billions of dollars, hundreds of billions of dollars on tightening the spread against of mortgage rates in the free market. And I think that these are the types of things where politics come to make solutions, and we'll see more of these things. And the reason I only bring this up is this is a small niche problem, but imagine if there's imagine what happens if unions start going on strike because they can't get jobs because AI is taking over the industry. Like you see how it's very easy for politics to step in and hinder advancements in the technology.
Yeah.
Or at least the absorption of it.
Or it might be a way to introduce some sort of universal basic income.
I think that before anybody does that, because see, there's a problem with UBI, and this is a bit more philosophical. And if people don't have anything to do with their time, you can give them any money that you want. But I think that if society lacks a purpose, right, whatever it may be, if society lacks the initiative to get up in the morning, get out of bed and go do something, UBI only handles the aspect of people not making money with what they're doing. But if you give the entire society UBI to do nothing, I feel like you as a social class and societal health will decline. So I think that there's a lot of repercussions here of just saying that we can automate the entire world and we can just all pay each other monopoly money and run around and spend it.
Yeah.
I feel like there's a very fine line that has to be balanced here. Otherwise you just get, money has no meaning if everyone's just getting it, right?
Yeah,
doesn't mean anything. And we as humans, we desire to be among social classes, and we have a desire to function, and maybe it changes the path of humanity. But in terms of its economic absorption, I think that there are far too many structured players in the economy to let the entire industry be revamped by artificial intelligence, gutted, I should say, not revamped's the wrong word, to let the entire economy be gutted by artificial intelligence. There's too many people in power that that would not let that happen.
Yeah. I mean, we're still so far away from that, and there's still
Exactly.
so
Yeah.
many different industries that AI is not even really a part of just yet. So there is still a lot of room for growth.
No, and that's the point. So this goes back to the point earlier. How much can AI be absorbed into the economy before you hit that wall? And that wall may not necessarily be. Um, a good example is to think about it like this: the argument that we can produce cars cheaper with robots, we don't need people to work, right? And we can use AI. We can already do that in China, right? But we don't let the Chinese auto manufacturers sell in America. The reason we don't do that is they have a competitive advantage where they have such a low cost of labor that they would flood the market and we just own Chinese cars. So like the reason that we have these things, the reason we have tariffs in place and these things in place is we have to protect our economy. And if AI becomes a threat beyond just optimization and more towards actual material job losses, there'll be Senate hearings in Capitol Hill and there'll be all sorts of things that come out of it. It's just the way it works. I think a lot of people are afraid of like what's going to happen to the world, and I think you have to look at it more of like a tool, if anything, not a replacer. And it will like just like the computer replaced a large group of people, new industries emerged, and I think that's very important in terms of what you're thinking about the path of AI here, right? Because it's very exponential in terms of what it can do, and it doesn't necessarily need to replace everything in the process. So you can argue that it's probably the most bullish catalyst of the you can if you wanted to make this argument you could say the 2020s just like the 1920s, right? The roaring 20s of the 1900s, the roaring 20s of the 2000s is the AI wave. That's what it's going to be. It's not going to just end one like overnight. It's going to be a prolonged thing because there's layers and layers of absorption with real tech. And that I think is the fundamental backbone for the persistence of a bull market and the persistence of an expanding economy. The question I think we need to always monitor and adhere to is, does that break at any point? For example, do you get into a position where the economy is tested, right? Do you get these periods of slow, basically contractions within expansions? These slowdowns, risk off environments they may not be real in terms of an outright recession, but do people's uncertainties raise? Like just a couple of months ago, uh, not even a month ago, Oracle was making headlines. Oracle CDS is all over the X feed, right? Everyone was ripping and roaring about Oracle. It's going to go under. It's going to be the one, right? That was it. And that imposed further stress in equity markets. That imposed further stress in the bond market, specifically corporates, right? And I think that these are the things that happen in an environment like this, where the theme is very subtle and persistent, but it gets constantly questioned, and we have to be ready for those windows of questioning until something does break.
Yeah, and
And
I think on top of that too, you get waves where it's so good the market runs way ahead of what reality actually
yes,
is, and I think that's what we saw back in October, November as well, where just these expectations get
expectations,
so
yeah, yeah.
stretched that it just ends up pulling back at some point, and we sure enough had a risk off period during that time. So clearly those expectations getting stretched are enough to trigger our system's risk off catalyst.
Right. Yeah. We can't sit here and say, like, I think that nothing's like, there's an old saying that I always remember that it's never going to be as good as they say or as bad as they say. It's always going to be somewhere in the middle. Right. So no matter what anyone says, it's usually never going to be as good and vice versa. So I do think AI is a monumental shift. I think it's what's going to fuel the roaring 20s of this decade. Right. It has been and will continue. However, I don't think we're going to instantly cure cancer or whatever it may be, like as we've been pitched, right? Like I don't think that that's how this is going to work. And I think that this is one of these things where it's bullish, it's positive. You can't crap on it because it is valuable, but it's also not exactly what everyone's making it out to be. You know, you're in a position where the innovation is happening beneath you, but it's becoming more and more subtle across sectors that I think allow for more diversified and more articulate approaches in the market, right? Google will lead, like these companies that are leading AI will continue to lead, but then you'll have these follow-up things, these follow-up sectors that are starting to pick up benefits of AI, that they'll start to come up and they'll start to, be valuable performers in the market. So the idea that Mag 7 is just going to be the only thing that wins for the entire run, I think that's a little blunt, and I think that's just something that the mega cap holders, the people that are just long, just long mags, they're literally max long Google or whatever. They want to pitch that as a thesis. But I do think that if the tech is real, which I believe it is, there'll be follow-on effects that will fuel persistent and continued growth that go just beyond Gemini API volumes or things like that. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.